In this video, we are going to talk about one of the most popular topics on YouTube and the internet in general, which is ICT. So ICT looks to carry trades at extreme points where we call liquidity grab is actually going on. So in this particular video, we are going to explain a little bit about ICT straight to the point, and at the end of the video, I'm going to give you a strategy which you can implement on your own. So what is ICT? And for the sake of those who have never come across this particular method, it is one of the best trading strategies which can be applied to indices, Forex, or even bonds, shares, and so forth. ICT stands for Inner Cycle Trader. However, there is a ton of information pertaining this topic, but we'll try to simplify one of the tradable methods of ICT. Before we go on, check out our free Telegram channel where we share free signals. The link is right in the description box below. So, ICT looks to find the market bias via market structure. By market structure, we are talking of higher highs and higher lows, or vice versa, where we are saying to see if the market is going in an upward direction, we would need to see higher highs and higher lows being created and break of market structure. Break of market structure to the upside creates what we call fair value gaps. We are not going to talk about FVGs in this particular video. However, for one to make an entry, you should find a point where there is liquidity grab. So liquidity grab is the fundamental starting point of this particular trading method. The biggest question is, how do we find this point of liquidity grab within the markets? And if you master how to find these points of liquidity grab, you will actually be able to trade with high accuracy using ICT. In the next slide, we'll talk on how to attain the liquidity grab. So ICT bases more on time. What time is it? And we are not going to talk much on that in this particular video. Whenever there is a day of consolidation, it is a sign that there is contracts accumulation. Day of consolidation, we are saying whereby the day starts and ends in this particular case. But later we are going to define what a day of consolidation looks like when we define the trading strategy using ICT. Price tends to go above the highest price of accumulation. Like for instance, if this occurs within the market, we've said it's actually a sign of liquidity grab. So the market tends to go above these zones of consolidation to grab the stop losses of people that were trapped within this particular consolidation. Let's see a strategy that we can implement using this particular information. So the first thing we need is to go on the H1 time frame to attain market bias. We are now defining a strategy that you can use the information that I gave you earlier. Market structure helps us attain this by looking at how structure is being broken, meaning if there is creation of higher highs and higher lows, we are in an upward market context, and the vice versa is true, whereby we have lower lows, lower highs like that. We are actually in a downward market context. If it's that case, we are looking to grab liquidity by hitting stops of buyers in an upward market context or stops of sellers in a downward market context. With the particular set bias, look for days of consolidation. And a day of consolidation can be defined by day open price is equal to day closing price. So if we actually put session markers on TradingView or period separators on MT4, we can switch an H1 time frame chart to days demarcators. So we are saying if the price of a day, which is this one, is almost equal to the price of its closing, we define this day as a day of consolidation. We did not have rise, we did not have drop. So we are saying we are looking for days of consolidation within the market context that we have set. So by looking for these days of consolidation, we are saying the point of liquidity grab is a point whereby we stitch below the lowest price of the previous day. Let's now have examples on real markets. But before we do so, check out our Telegram channel where we share advice and signals. This is USD against Swiss franc. In this particular case, we are now on the M15 time frame where we would see liquidity grab with ease. The first thing was actually to find this as a lower high whereby the market is broken from the downward side. So in this case, we are in an upward market context. This was a day of consolidation, and as we defined, we can see its opening price being almost equal to its closing price. The day started at this period separator demarcator to this one, which are these black traces on my charts. The next thing was actually to have liquidity grab and go in the direction of our market bias. Liquidity grab was actually to go below the low of the previous day of consolidation. As you can see, the market induced, traders went up, and within this drive, there were buyers who were putting stop loss a tick or two below the yesterday's low price, which was later came back to be grabbed, and the market went up. Therefore, your entries should look to be below this point or at the zone of liquidity grab anticipation. At these zones, you need to switch to the lower time frames so you can see properly how price behaves when it goes below the previous day of consolidation. Let's have another example on pound USD. If we go back in history to see, we can see that the market was actually trending in a downward move and we had a day of consolidation. So in this particular strategy, our job is to be looking for days of consolidation where the market opened and is almost equal to the closing price of that day. In this case, we can see the market actually came above this zone. Why? Because that was the zone where there was stop losses of sellers who were actually trading, probably using trend lines and so forth. If we construct a trend line, we can see that usually most people had their sell orders at this zone, and then the market had to come above that zone to grab the liquidity. So to simplify or to summarize everything that I've said earlier, we are looking for days of consolidation within a market bias, right? If we go forth, we can look for another example where that occurred. In this case, we were now in an upward market context, and within that market context, we can see this day opening at this point and closing at this point. Within that, we know if there is a day of consolidation, usually the market will go below the low of that particular day to actually grab the liquidity which occurred at this point. From that, we can see that on this day, they had not sufficient contracts to move the market. So what they did was they also consolidated for that particular day. Opening price and closing price were almost in the same line. After that, we can see the market actually coming back using news to come and grab the liquidity. So there was liquidity grab twice. From this day, it was grabbed at this point, and from this day, it was grabbed at this point. And the market went right up in a very fast manner whereby that couldn't allow traders probably to close off their trades when they were trapped. So basically, that is how you use this particular strategy. You use the ICT methodology to find proper entries and the ones that are loved by a lot of people, the sniper trades. On that note, we come to the end of this video. Thank you for watching and check out all other videos on our channel. See you on the next one.